Most financial mistakes do not begin with ignorance. They begin with certainty. This is worth pausing on because it runs counter to how most people think about financial error. The common assumption is that poor decisions come from lack of information, insufficient analysis, or limited experience. And sometimes they do. But the more consistent pattern, particularly among capable and analytical people, is something quieter and more personal. It is the feeling of knowing. There is a specific kind of confidence that emerges when an intelligent person has done serious work on a problem. They have read the filings, studied the history, stress-tested the assumptions. The thesis feels solid, not because they are overreaching, but because the analysis genuinely supports it. The conviction is earned, and that is precisely where the trap begins. Because intelligence does not only produce conclusions, it produces narrative. And the narratives that intelligent people construct around their financial positions are often elegant, well supported, and deeply persuasive, especially to themselves. The analysis becomes a story. The story becomes a belief, and the belief over time becomes something harder to examine honestly. We tell ourselves we are following the evidence. What we are often doing is protecting a conclusion we have already reached. We also confuse correctness with control. A thesis that turns out to be accurate feels like evidence that we understood the situation. And in some cases, we did. But markets are probabilistic environments. A correct outcome does not always mean the reasoning was sound, and a sound reasoning does not always produce a correct outcome. Conflating the two leads to a particular kind of overconfidence that is almost impossible to detect from the inside, because it is continuously reinforced by selective memory. The thesis here is not that certainty is always wrong. It is that markets do not reward the need to be right. They reward the ability to adapt. An adaptation requires something genuinely uncomfortable. The willingness to detach from your own conclusions, even the ones you built carefully and hold with good reason. That detachment does not come naturally. Understanding why requires looking at what happens when a forecast stops being an analytical position and starts becoming something more personal. At some point in the life of a financial position, a subtle shift occurs. It begins as analysis, a set of conditions, a thesis, an expected outcome. But once a prediction is made, something changes in the psychology of the person who made it. The forecast is no longer just an idea about the world. It has become, in a quiet and largely unconscious way, a statement about the person who holds it. This is not vanity. It is something more structural. Human beings are not naturally dispassionate about their own beliefs. We are invested in them in ways that go beyond their intellectual content. A belief that turns out to be wrong does not feel like updated information. It feels like a small defeat. And when that belief has been stated publicly, the stakes rise considerably. Research on commitment and consistency shows that public statements create psychological contracts. Once we have told colleagues, written in a newsletter, or argued the position in conversation, reversing course requires not only changing our mind, but revising the identity we have presented to others. The social cost is real, and we respond to it accordingly. Daniel Kahneman's work on loss aversion is usually applied to money, but the same architecture operates in the domain of ego. The pain of being wrong, particularly for people who have built professional identities around the quality of their thinking, is not proportional to the magnitude of the error. It is often disproportionately large because what feels at stake is not just the position, but the judgment that produced it. This is why intelligent investors average down into losing positions long past the point where the original thesis warrants it. Not because the analysis supports adding to the trade, but because adding to it is a way of restating confidence in the original call. It is a commitment device, a way of signalling to yourself and others that you have not changed your mind, that the market is the one that's wrong, and that patience will eventually produce vindication. The market is not arguing with you, it is simply moving. That distinction is easy to state and genuinely difficult to internalize. When prices move against a carefully constructed thesis, the natural human response is to look for reasons why the movement does not matter, or why it represents an opportunity, or why the people on the other side of the trade are missing something. The analysis that follows is not neutral. It is recruited in service of a conclusion that has already been reached. The danger is not being wrong. That is recoverable. The danger is the decision to defend wrongness and the escalating cost of that defense over time. There is a particular dynamic that takes hold once a position has been held long enough and defended often enough. The original thesis becomes increasingly difficult to examine honestly, not because new evidence is unavailable, but because the psychological investment in the position has grown alongside the financial one. This is what behavioral economists call escalation of commitment. The longer a course of action has been pursued, the harder it becomes to abandon it, independent of whether the underlying rationale still holds. Sunk costs, which have no bearing on future expected returns, begin to feel like reasons to persist. Every additional dollar invested carries emotional weight. Every month of holding becomes a kind of implicit argument for continued holding. The position is no longer just a position. It is a record of decisions made, of confidence expressed, of time and capital committed. Walking away means writing off not only the money, but the reasoning that led there. Confirmation bias operates quietly alongside this. Once a thesis is held with conviction, the information environment surrounding it begins to shift. We read more of the analysis that supports the view and engage less with the analysis that challenges it. This is not deliberate distortion. It is the natural tendency of a mind that has already reached a conclusion and is now, largely without awareness, curating the evidence accordingly. Charlie Munger spoke about the importance of what he called destroying your best-loved ideas. The phrase is deliberately forceful because the act it describes is genuinely difficult. It requires identifying the beliefs you are most attached to and subjecting them to the harshest scrutiny you can manage. Not to be contrarian, but because attachment is precisely what makes those beliefs the most dangerous. The positions we hold with the greatest conviction are the ones most likely to benefit from honest re-examination. The more you invest in being right, the more expensive it becomes to change your mind. That cost is not only financial, it accumulates in time, in missed alternatives, in the narrowing of attention that comes from defending a single thesis against an increasingly complex reality. Markets do not charge for humility, they charge for rigidity. There is a meaningful difference between investing to be right and investing to survive. The distinction sounds obvious. In practice, it is one of the most consistently ignored principles in portfolio behavior. Short-term validation, the feeling that the market is confirming your thesis, is immediate and emotionally satisfying. Long-term survival requires tolerating extended periods where the market offers no such confirmation at all. Warren Buffett has spoken openly about mistakes he made and positions he held too long. What is less discussed is the behavioral architecture behind his willingness to do so publicly. Admitting error quietly, adjusting without drama, sitting in cash when nothing compelling is available, these things do not look impressive. They do not generate attention. In an environment that rewards confident forecasting and punishes visible indecision, the behaviourally stable investor often appears to be doing very little. That appearance is not a weakness. It is frequently the strategy. The core idea here is asymmetric. You do not need to be right often. You need to avoid being catastrophically wrong. A small number of large, irreversible losses can permanently impair a portfolio in ways that years of solid returns cannot fully repair. This changes the calculus of decision-making in ways that most analytical frameworks do not naturally capture. Position sizing matters more than most investors acknowledge. Keeping positions at a scale where a full loss is survivable is not timidity. It is a structural acknowledgement that even well-reasoned theses fail, and that the ability to continue participating in markets after a loss is itself a form of edge. Optionality matters for similar reasons. The investor who has preserved capital and flexibility can act when genuine opportunities arise. The investor who has concentrated heavily in a defended position and cannot exit without significant loss has surrendered that ability. The capacity to pivot is not a luxury. In uncertain environments, it is a primary source of long-term advantage. The most durable investors are not attached to outcomes. They are attached to process. And the process that survives over decades is almost always one that treats flexibility as a feature rather than an admission of uncertainty. We return then to where we began. Markets do not reward the need to be right. They reward the ability to adapt. And the ability to adapt requires a specific kind of psychological discipline that does not emerge automatically from intelligence or experience. It has to be built deliberately, often against the resistance of instincts that have served well in every other domain. The separation that matters most is between identity and position. Your portfolio is not your personality. Your thesis is not your worth. These statements are simple enough to agree with in the abstract, and surprisingly difficult to act on when capital is at stake and a carefully constructed argument is moving against you. What makes the separation possible, in practice, is building the systems before the pressure arrives. Defining exit conditions before entering a position removes the decision from the moment when ego is most activated. Treating every belief as a temporary hypothesis rather than a settled conclusion preserves the ability to update. Sizing positions in ways that make losses survivable removes the desperation that turns a poor trade into a defended identity. None of this is about being passive or indifferent. It is about locating conviction in the process rather than in any particular outcome. The process can be trusted. Individual outcomes in a probabilistic environment cannot. The investors who compound quietly over long periods are rarely the ones with the sharpest forecasts or the most confident public positions. They are the ones who built a relationship with uncertainty that did not require resolution. They could hold a thesis lightly enough to release it when the evidence shifted, and they did not need the market to confirm their intelligence in order to continue. That is a quiet advantage. It does not announce itself. It accumulates. The market does not care if you are right. It only cares whether you are solvent, and solvency belongs to those who can change their mind.